The second wide-angle story on the show, which is about Indian economy, and in recognition of the rising heft and the massive growth opportunity that the Indian economy now has, the World Bank has upgraded the growth outlook for the current financial year for India to 7% at a time when the Chinese economy seems to be struggling to meet its growth forecast. In addition to that, there's been an increase in India's weightage by Morgan Stanley in its emerging markets index, which sets the stage for India's rapid rise to a $7 trillion or possibly a $10 trillion economy in the next 5 to 8 years. Take a look at this report that breaks these trends down in greater detail.
Weeks after the IMF upgraded the forecast of the Indian economy to 7%, the World Bank has followed suit. And in line with global growth expectations, Morgan Stanley's latest report gives India the largest weighting in the Emerging Markets Investable Index, effectively overtaking China. The data shows a better-than-expected outlook for the world's fastest-growing economy. The bright economic outlook, coupled with higher weightage on the index, is set to translate into more global flows into India, allaying fears that the Indian equity markets may be primed for a correction. In fact, FPIs bought shares worth $6.33 billion in 2024, on the backs of earnings growth for Indian companies, which is higher than other emerging markets by 60%. Indian equity markets are also a lucrative investment destination due to the higher return on equity, a matrix where China has halved since 2014. The World Bank upgrade has come on the back of higher public investments and a surge in household investment in the real estate sector. Meanwhile, the World Bank says India remained the fastest-growing major economy and grew at a rapid clip of 8.2% in the 2023-24 financial year. The upgrade from the earlier projection of 6.6% comes at a time when the Chinese economy is struggling and facing headwinds, mostly due to its real estate sector and its cascading impact on the Chinese banking system. The housing crisis, which has been ongoing for nearly 4 years, has now impacted household earnings and the financial sector. Adding to the worries over the health of the Chinese economy is a lower-than-expected services growth. The IMF has termed services as an underutilized growth driver for China, contributing far less than its potential. Sparking fears of a larger risk is China's factory activity, which contracted for a fourth straight month in August. The contraction indicates the world's largest economy may struggle to meet its growth target of around 5%. For New Delhi, its task is cut out. It needs to prioritize getting big-ticket investment and press the pedal on its $1 trillion manufacturing goal, which requires favorable trade pacts. As the global trade landscape gets more protectionist, India's trade policy holds the key to its growth trajectory.